Welcome to this explainer. If you've been watching the pharmaceutical sector lately, well, there's really only one name that has completely stolen the spotlight, right? Eli Lilly. Today, we're diving deep into their staggering Q2 2026 earnings report. We're going to break down exactly how their absolute dominance in the weight loss drug market isn't just printing massive amounts of money today, but how it's actually funding some incredibly radical, visionary acquisitions for tomorrow. We've got a lot of ground to cover, so let's just jump right in. Okay, here's our roadmap for today. We'll be looking at the hockey stick quarter, the supply chain arms race, the $1,000 stock question, securing the future, and finally, the bottom line. Let's kick things off with Section 1, the hockey stick quarter. We're breaking down these Q2 2026 financials. To put it plainly, Eli Lilly pulled in a massive $23 billion in revenue just in this quarter alone. When you put that number into context, it represents a staggering 48% increase year over year. I mean, in the financial world, that isn't just your standard growth. That is a true hockey stick trajectory. It's the kind of explosive upward curve that completely redefines a company's position in the market. Now, Wall Street analysts were definitely bracing for a good quarter. Their consensus estimate for earnings per share, which is basically just a company's profit divided by its outstanding shares, was sitting right around $6.01. But Eli Lilly, they completely blew that out of the water, delivering an actual adjusted EPS of $8.38. So they didn't just beat expectations here, they absolutely shattered them. And if you're wondering where all that cash is actually coming from, it essentially boils down to two heavy hitters in the GLP-1 drug class. Mounjaro, which is approved for type 2 diabetes, jumped 91% year over year to generate $9.9 billion in revenue on its own. Meanwhile, its obesity-specific counterpart, Zepbound, brought in another $4.9 billion. Put those together, and these two drugs are raking in nearly $15 billion in a single quarter. Just think about that for a second. That is literally more than most large-cap pharmaceutical companies make in total revenue across their entire product portfolio for a whole year. Driven by that massive $15 billion combined quarterly haul, management is, as you'd expect, feeling incredibly optimistic. They've confidently raised their full-year guidance. Previously, they were targeting between $82 and $85 billion. Now, they've bumped that up to a new range of $85 billion to $87 billion. At this phenomenal rate, putting a $100 billion annual run rate in sight for next year isn't just some pipe dream anymore. It's becoming a mathematical probability. But how do they actually deliver on all this demand? That brings us to Section 2, the supply chain arms race. Let's look at how they're solving this massive demand bottleneck. The really crucial point here is their rapid pivot to U.S. manufacturing. Just take a look at this breakdown. In January, they announced they're pouring $3.5 billion into a brand new Pennsylvania plant. And get this, that plant is dedicated entirely to their next-generation weight loss drug candidate, Retatrutide, which is creating 850 high-tech jobs. Then in July, they partnered up with a contract manufacturer called Resilience, investing another $750 million in Ohio for 400 more jobs. And to actually fund this massive stateside push, they're actively scaling back their international plans. They literally cut a €2.3 billion project in Germany right in half just to redirect those funds back to the United States. And this matters immensely for anyone observing the pharmaceutical space. Supply chain constraints have honestly been the primary bottleneck, keeping Eli Lilly's sales growth from climbing even higher. They literally have patients waiting in line. If these new U.S. plants come online exactly as scheduled, Lilly will finally have the sheer physical inventory required to capture that massive global demand that is currently just waiting on the sidelines. So with all this manufacturing scaling up, let's briefly look at the stock itself. Section 3, the $1,000 stock question, market reactions and retail buzz. Because shares are now sitting comfortably well over that $1,000 mark, financial analysts are beginning to whisper a phrase that gets retail investors incredibly excited. You guessed it, a stock split. Management hasn't made it official just yet, but given the trajectory, the market is practically begging for it. To understand why, you have to realize that Eli Lilly is currently one of only 15 companies in the entire S&P 500 trading above that $1,000 threshold. A stock split wouldn't actually change the underlying fundamentals of the company. It's the exact same pie, just cut into more slices. But it would make those shares so much more accessible to your everyday retail trader. But what happens when they inevitably run out of room to grow? That brings us to Section 4, securing the future. We're looking at their big swings in AI and psychedelics.
Rather than just resting on their incredibly lucrative GLP-1 laurels, Lilly is playing the long game here with technology. Back in March, they extended a massive partnership with In Silico Medicine. We're talking about a deal worth up to $2.75 billion. The goal? To hunt for the next blockbuster drugs using artificial intelligence, specifically targeting complex areas like cancer and neurodegenerative diseases.
Now, right as you process that pivot into AI, you might be asking yourself a very valid question about their next big acquisition from this past July. Psychedelics? It certainly sounds like a pretty massive leap from diabetes and weight loss, right?
But honestly, when you look at the data, it makes perfect strategic sense. They're taking that massive GLP-1 cash flow and leveraging it. They dropped $2.8 billion upfront to acquire Beckley, a clinical stage company. Basically, they're trying to crack the code on mental health, which pretty much everyone considers the pharma industry's next major frontier. They're looking at using psychedelic compounds to target treatment-resistant depression and PTSD. It is a high-reward swing that could easily establish a completely new pillar of revenue for the next decade.
All right, let's synthesize everything we've uncovered. Section 5, the bottom line. Here are your key takeaways and the market reality. To summarize the core narrative here today, Eli Lilly is simply firing on all cylinders. Their fundamentals are absolutely booming with that 48% growth and raised guidance. They're actively solving their supply bottlenecks by injecting literal billions directly into U.S. manufacturing. And most importantly, they're ensuring they aren't just a one-trick pony by diversifying their pipeline into cutting-edge therapies with AI and psychedelics. However, to keep things completely objective, we do have to look at the market reality. The sources note that the stock is currently priced for perfection. And when a stock is priced that highly, there is very little room for error, meaning any unexpected manufacturing delays as they build out these new plants, or, say, a sudden breakthrough drug from a competitor could easily trigger some really sharp market volatility. So I will leave you with this final thought to ponder. With nearly $100 billion in annual revenue clearly in sight as they pour billions of their weight loss profits into these totally unproven frontiers, will these radical bets on AI and psychedelics secure their absolute dominance for the next decade? Or is the weight loss king flying a little too close to the sun? Thank you so much for joining me for this explainer, and definitely keep your eyes on how this massive pharmaceutical shift plays out.